This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Sharp sell-off, a second day of triple-digit declines for the Dow, marking the first time this year that the major indexes have fallen in back-to-back sessions.
Healthcare tapeworm. Warren Buffett, Jeff Bezos, and Jamie Dimon are joining forces to create a system that costs less and gets better results.
And State of the Union, the president addresses the nation tonight on Capitol Hill, and the economy will be front and center. Those stories and more on Nightly Business Report for Tuesday, January 30th.
Good evening, everyone, and welcome. It was ugly. Stocks fell sharply, extending yesterday's losses. Healthcare shares took a tumble, and we'll have more on that in just a moment. And bond yields rose to a near four-year high, and that was enough to batter stocks, falling the most since August. The Dow Jones Industrial Average dropped 362 points to 26,076. The Nasdaq was off 64. S&P 500 was down 31. Bob Pisani has more on today's sell-off from the New York Stock Exchange.
The steep sell-off continued today on Wall Street, bringing the Dow down 400 points at the session lows. We haven't seen that in a long time. Remember this game? The game for the last few months has been go long the global economy. That's exactly what was weak today. Energy, semiconductors, industrials, these are key economic benchmarks. They were all down today. What's going on? Well, there's several risks to the market right now. Call it a little stew. First, rising interest rates continue to be the big story. Bond yields are hovering right around four-year highs. And with a potentially more aggressive Federal Reserve this year, investors are starting to get a little bit nervous. Second, there's the earnings question. Some are arguing that the acceleration in earnings growth this year that has powered the markets higher will start to slow down next year. That might imply a lower multiple for the markets. Finally, sentiment levels are at their highest levels in many years. Goldman Sachs and Bank of America Merrill Lynch released their bull-bear market indicators recently. They've hit their highest levels in at least 5 years for Merrill and 10 for Goldman. That signals a possible correction could be coming in the near future. The global markets have enjoyed their strongest start in any year for 3 decades. So there's little wonder we're starting to see some pent-up selling pressure starting to appear. So far this January, it's been a little bit more volatile. We haven't seen that in a while. The S&P has made moves of 0.5% or more about 10 times already this month. That's a rarity in the last couple of years. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Federal Reserve policymakers are meeting. It is Janet Yellen's last conclave as Fed chair, and while no interest rate hike is expected to be announced tomorrow, investors do wonder what lies ahead. Steve Leisman has the results of the latest CNBC Fed survey.
Market participants are looking for a bit more from the Federal Reserve this year when it comes to interest rate hikes. 95% of our 40 respondents see no hike coming at the meeting this week, and 90% say the first 25 basis point rate hike will come in March. But they're looking for 3 rate hikes this year, actually 3.21. What does this mean? It means your average person looks for 3, and the second most common answer is actually 4. That's a change from the last survey. Now that we're adding in or starting to think about that 4th rate hike this year, and you can see that in the outlook for rates. The 2018 average, 2.2%, or a full percentage point and then some when it comes to the Fed rate hikes. 2019, 2.8, not much more in 2020, but the long run, 3.2%. That's also higher. So overall, looking for more in the way of interest rates. You can see that also in the 10-year yield, where the current rate is around 2.7, going to 3 at the end of this year and 3.4 at the end of 2019. That's not too bad. If you think about where we were a year ago, that was really the expectation for this year at the beginning of 2017. Higher rates may weigh on the market. 28.54 was close of business yesterday, 29.37. So just really 3 or 4% up from where we are right now by the end of this year, and just 3,005 for the S&P by the end of 2019. But even when we get higher rates, we'll also get maybe a little bit more growth. Take a look at the GDP forecast. We've gone up, 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 up in each successive survey, adding about half a point to close this year. The expectation is almost 3%, 2.7% for next year. These are better numbers than we've seen, in part because of the tax cuts. That's really the expectation this year. The tax cuts drive better growth, at least this year and into next year. For Nightly Business Report, I'm Steve Leisman.
As we mentioned earlier, today does mark the second down day for the major averages. So is this market sell-off just a blip, or does it signal the beginning of a more meaningful pullback? Joining us on set is our bear, Peter Bookvar, Chief Investment Officer of Bleakley Advisory Group and editor of the book report. He thinks the market has already seen its best days for this year. And joining us tonight as our bull is Peter Mallouk. He's the Chief Investment Officer of Creative Planning. Gentlemen, nice to have you here. Great night to have you.
Good to be here.
Peter Mallouk, let me start with you if I could. It was kind of two very rocky, ugly days. What makes you think that maybe this is the end of it and we could turn higher again?
Well, I don't know that this is the end of it, but I think it's way too early to call this the downfall of the markets. What isn't abnormal is today. What's abnormal is the 450 days that have preceded today, where we broke a record for the most days with very low volatility in a row. Last year, the first year in history that the global markets are positive every single month. That's not normal. It's normal for the market to go up and down, to have its off days, to absorb some less than incredibly positive news, but there's really not substantial new news. We just need to have a breather, and I think it's very positive for the market to eventually have some minor pullbacks, maybe even somewhere along the way get the correction that's supposed to happen every year on average anyway. We have to go all the way back to the beginning of 2016 to see a correction, and that barely even qualified as one. And so that to me is what's abnormal, is the lack of any volatility.
Peter Bookvar, you are our bear tonight. You don't look too frightening. You're a nice guy. No, you're not hairy. You're all good. But you say that it wouldn't surprise you if we hit the high for the year last Friday. Why do you feel that way?
I tie it to interest rates and global monetary policy. The world is changing. A key driver of this bull market was PE multiple expansion via zero rates and QE. So now we have what, on certain metrics, the most expensive market we've ever seen. And now we have rising interest rates. And we have an intensification of Fed tightening via quantitative tightening and more rate hikes. And we have the ECB pulling back, and the Bank of Japan, and the Bank of England, and the Bank of Canada. And I'm worried that we're going to see multiple compression, which will be a dampener on markets this year.
So the past couple of days have been a tremor. Do you see an earthquake coming? Do you see something different than that?
I think it will depend on the rapidity of this move higher in interest rates. If it continues, if we do see 3% plus in the 10-year, that's going to be a really big deal because, again, it happens in the context of an extraordinarily expensive market and an economy that has become addicted to very low interest rates.
Okay. Peter Mallouk, let me go to you. You make the case, though, that we have a very healthy economy underlying, regardless of whether it's addicted to low interest rates. But can you still, given the run in this market, can you still find value here at home if indeed you think the bull case is still intact, or do you need to look elsewhere?
Well, I think you could. First of all, I don't think the markets are overvalued. If you go back to 2010, everyone complained that we had high unemployment and corporations didn't have enough cash. We didn't have good earnings growth. And today we have the opposite. We have exceptionally low unemployment. We're getting into the threes now, which is where you start to see wage inflation, which is a very good sign of economic strength. And I think that the market's also seeing corporations holding near record cash. And they look at more people employed, and people will probably have more money in their paychecks because we're going to see wage inflation. If you have unemployment go from 7% to 6% and you want to hire somebody, well, they're unemployed. You go hire the unemployed person. When it goes from 4 to 3, you better hire them. You have to hire them from somebody else. And to do that, you have to pay them more. It's that wage inflation that starts to create real inflation, which is why the Fed would raise rates. So it's an interesting circle because the Fed's only going to raise rates if they think the economy is strong enough to hold it. That doesn't mean they're perfect at it and they'll have some false starts. I'm not saying the market's a value, but it makes sense where it is. It makes sense that we expect greater earnings going forward than we did 5 years ago when the market was at a lower price.
All right. To be continued, gentlemen. Thank you so much. Peter Bookvar with Bleakley Advisory Group. Peter Mallouk with Creative Planning.
Thank you.
As we reported, healthcare stocks dragged the market lower today. Shares of insurers, drugstores, drug distributors, they all fell. The decline was in response to a new venture that could disrupt the industry. And as Bertha Coombs reports, the venture is the brainchild of 3 of the biggest names in American business.
Calling rising healthcare costs a tapeworm on the economy, Amazon's Jeff Bezos, Berkshire Hathaway's Warren Buffett, and JP Morgan CEO Jamie Dimon say they're joining forces to simplify their employee benefits using technology and to try to drive down health costs. The news seen as a shot across the bow to insurers.
With Amazon in play, it reflects an almost evangelical faith that people have that they can disrupt established business patterns in the way that they've done in many other industries. I think we really need to see some more details.
It's still in the early planning stage, but what could make this different from other employer cost-cutting initiatives is that the firms are forming their own company. The question is whether they'll try to save money by knocking out the middlemen who negotiate hospital networks and prices and pharmacy benefit contracts with drug makers.
I think that those who are selling their shares in healthcare stocks are reading this all wrong. The middlemen here have an interest that is aligned with the employers. They are the intermediaries with the healthcare providers. And the main problem with healthcare these days is the fact that costs and quality are not aligned.
In fact, healthcare firms hailed the news. Aetna and CVS, which want to merge their insurance and pharmacy into an integrated health clinic service, both said they'd welcome the chance to help the firms with the new business model. Until now, the fear had been that Amazon would enter healthcare as a competitor to these services, but combining with other employers would still put the tech giant in a position to exert pricing pressure on the healthcare industry.
The best results that we've seen have come from jumbo employer efforts, from them either teaming together or doing pilot projects on their own to prove that something is a good idea, and then everybody else gets in line and adopts similar approaches.
It's not clear how soon the new company will launch or where it will be headquartered, but with tech giants like Apple and Google also focused on healthcare these days, industry players are very much bracing for continuing disruption. Bertha Coombs, Nightly Business Report, New York.
All right, let's talk more about this very interesting partnership among Amazon, Berkshire Hathaway, and JP Morgan and what it might mean for the healthcare industry. Joining us to discuss that is Michael Baker. He's a healthcare analyst with Raymond James. Michael, I have to confess, I'm a little bit unclear on what these three intend to do and how they intend to do it. Can you shed any light on that?
Yeah, I mean, based on what they've said so far, I think the initial focus will be on enhanced transparency, because we as consumers are being asked to pay more, given those high deductible plans, yet we don't have the tools in hand to effectively shop and balance cost and quality. So I think that that will be one thing. I think also internally they'll try and figure it out first before they try and spread it out. And I was also kind of interested to hear that they plan or selected kind of a nonprofit organization, because if you really wanted to make a big bang with a new entity, you might want to start for-profit, kind of drive more capital in. So at this point, it doesn't look like they're trying to build their own healthcare system. It looks like they're trying to make it more efficient and put, as others have said, margin pressure on it, so to speak.
And what do you think about their odds for success? I mean, we've seen Amazon disrupt so many different industries very successfully. And these are three really smart men. And maybe that's why the stock sold off so dramatically today. But what do you think their success rate might be? It's a big undertaking.
No, it's a big undertaking, and it is a very fragmented industry. I mean, it's one of the few service areas where we don't know the cost up front. We don't know until after the process. So to date, what healthcare investors have kind of learned is that moves like this tend to be more evolutionary change rather than revolutionary change. There's actually a consortium known as the Health Transformation Alliance, which is a group of 40 employers. They are starting to make some change in the pharmacy benefit area, but I would say evolutionary at this point. Well, obviously, the details are scarce at this point, and it remains to be seen. But that would be my bet at this point.
So quick answer here. You know, I agree with you totally. The whole business is so fragmented, and you have all kinds of players eager for profits and often making huge profits through this. But today, the stocks almost across the board went down. Do you think that that stock retreat is going to be enduring because of this, or was it a one-day reaction?
No, I think there'll be fits and starts. I think part of the reason we saw it, if you remember late last year, there were a lot of concerns that it would be Amazon coming in. They'd either buy a PBM or buy a distributor and dramatically change that. And then it started to abate as it didn't seem like they were following through on their licenses. So you had an early big strong move in the healthcare stocks this year, and I think you saw some pullback on that as Amazon and its now counterparts raised their head again. So you'll see fits and starts. The next big announcement will be the CEO.
All righty. Thanks very much, Michael Baker with Raymond James.
Thank you.
You bet.
Take care.
Two Dow components reported earnings that topped expectations. Pfizer benefited from the new tax law and issued upbeat guidance. The biggest U.S. drug company plans to invest about $5 billion in capital projects over the next 5 years. Separately, McDonald's reported supersized sales and better than expected profits. The world's largest hamburger chain says that cheap menu items helped its results. Both stocks traded lower, though, because it was such a downside market.
All right, time to take a look at some of today's upgrades and downgrades. JP Morgan increases its rating on United Continental to overweight from underweight. The firm likes the airline's expansion plans and says the stock is the cheapest in the sector. Price target now, $83 a share. The stock closed at $67.01 today, up nearly 2% on this very downward day. And Nomura downgrades Yum Brands to neutral from buy. The firm cites concerns about a possible deceleration in U.S. sales at Taco Bell. The price target stays the same at $89. The stock did drop 2% at $84.59.
CVS Health was upgraded to strong buy from buy at Needham. The firm calls CVS its top pick for 2018. The price target on the stock raised to $100 per share from $88. Shares closed at $80.19, down 4%. Cowen says Skechers could announce a share repurchase. That firm cites management's optimism in its women's business and a favorable product cycle. The analyst calls Skechers its best idea for 2018 and maintains an outperform rating. However, shares fell in trading today.
And still ahead, open skies, why the U.S. airlines are celebrating a big win and possible future expansion in the Middle East. President Trump will deliver his first State of the Union address tonight, and the economy is expected to get a lot of attention. Eamon Javers is at the White House for us.
We are told that the president began making edits to this speech on the plane ride over to Davos, Switzerland last week, but that the actual speech writing began as far back as December, so there's been a lot of prep time here for the State of the Union. We also know a number of officials have been involved in giving their 2 cents to the President of the United States. The White House has given us a sense of some of the topics that will be included. Take a look at the list of those topics, including the economy, also infrastructure, the question about immigration and how that will be handled, trade, national security. All of those will be pillars of this speech tonight. Gary Cohn, one of the economic advisors who's been helping the president on the draft, said today that the president's going to talk about infrastructure and gave us a price point for that plan. Here's what he said.
What the president's going to talk about tonight, he's going to talk about 2 key principles on infrastructure. He's going to talk about $1.5 trillion of investment, but more importantly, he's going to talk about streamlining the approval process on infrastructure.
And something else to watch for tonight. On a day in which the Dow has been down significantly throughout the afternoon, will the president mention the stock market? He's been proud of stock's performance under his presidency. He would like to mention the stock market, we are told, but could that be awkward given the performance today? That's something else to watch for tonight. For Nightly Business Report, I'm Eamon Javers at the White House.
Harley-Davidson warns of slumping demand. That's where we begin tonight's market focus. The motorcycle maker said 2017 was particularly tough, with shipments falling to their lowest level in 6 years as demand among young buyers failed to pick up. The company did report stronger than expected earnings for the latest quarter, but said it believes shipments will continue to weaken this year. Harley-Davidson said it's responding to the challenges by cutting some jobs and closing one of its assembly plants. Shares were down 8% to $50.84. The new tax law cut into profits at the hospital operator HCA, but the company still managed to top expectations thanks to a rise in patient admissions. The healthcare company also said it plans to invest more than $10 billion over the next 3 years and continue looking at potential acquisition opportunities. The shares rose nearly 4% to $101.45. Higher selling prices helped revenue at the home builder Pulte to rise, but it was at a slower pace than analysts were expecting. Profits came in better than expected, but the company warned that rising costs due to a labor shortage would pressure its gross margins in 2018. And so the shares slipped 2% to $32.72.
Corning said strong sales of its Gorilla Glass used in smartphones helped overall revenue rise. Those results, along with profits, ahead of estimates, but the company did warn that upcoming investments would hurt profits in the first half of 18. Shares off 5% at $32.33. The lawn and garden company Scotts Miracle-Gro posted a worse than expected loss in its latest quarter. The company also said a slowdown in one of its subsidiaries would cause sales for 2018 to come in lower than initially expected. Revenue for the year now figures to grow between 2% and 4%. Shares plunged 14% to $91.96.
Renault-Nissan beat out Volkswagen to become the world's top-selling automaker last year. In 2017, Renault-Nissan sold 10.6 million vehicles. Volkswagen sold a little bit less. And falling one spot to number 3 is Toyota, which posted group sales of 10.2 million.
Well, after years of complaining about the expansion of airlines based in the Persian Gulf, carriers here in the U.S. are celebrating a big win tonight. Qatar Airways has agreed to changes that could help U.S. airlines expand in the Middle East. Phil LeBeau has the details.
As Persian Gulf airlines like Emirates and Etihad have expanded into the U.S., their growth has been a sore spot for U.S. airlines. They claim the Gulf carriers are subsidized by their governments, making it hard to compete on flights to the Middle East and parts of Asia. But today, the U.S. and Qatar agreed to changes that should help U.S. airlines. Qatar Airways will not add flights to the U.S. from places like Europe, which could undercut transatlantic competition. In addition, Qatar Airways will agree to accounting standards to ensure financial transparency and limit the use of government subsidies.
The President has made this matter a priority, and the outcome we achieved will ensure a level playing field in the global aviation market.
Delta is one airline celebrating the victory, which could eventually lead to the airline reestablishing flights to parts of the Middle East.
We need to have a presence in the Middle East. We need to have a presence in India and other parts of Southeast Asia, which we've been run out. And by shining the light on the scope of the subsidies and providing transparency, it's going to allow us all to make long-term investment decisions to go into markets knowing that our government's standing behind us.
Almost a year ago, Bastian and other airline CEOs met with President Trump at the White House. They raised the issue of Persian Gulf airlines competing unfairly, a complaint they've made to other administrations in the past, which is why U.S. airlines are celebrating a change that many never expected to happen.
We're being heard. We appreciate it. The question that every time I've talked to President Trump is basically, what can we do to help help America? And this is what he's done, and we strongly, strongly applaud him on that.
Next up for the Trump administration, trying to negotiate a similar agreement with Emirates and Etihad Airways, two airlines based in the United Arab Emirates. Phil LeBeau, Nightly Business Report, Chicago.
To read more about this win for U.S. carriers, head to our website, nbr.com.
Coming up, here come the tech earnings, and the bar is high.
It is a big earnings week for one of the market's best performing sectors. That would be technology. Tomorrow, Microsoft and Facebook report results, followed by Alphabet, Amazon, and Apple, the three A's, on Thursday. The sector has performed well, which is why there's a lot to watch in these upcoming results. Josh Lipton has more.
The bar is high. The sector is expected to post earnings growth that outpaces what's expected for the overall S&P 500. With that growth comes some well-known risks. Lawmakers have been asking a lot of questions, specifically about how Russian operatives used Google and Facebook to try and influence last year's presidential election. European Union regulators also targeted tech, including leveling a nearly $3 billion fine against Google. Despite those risks, some say these companies are still smart investments, that their core advertising businesses are strong, and valuation, they say, remains attractive. Tech investors are also interested in the impact of the new tax law, given that potentially hundreds of billions of dollars could now be returned to the U.S. Apple, Microsoft, Cisco, Alphabet, and Oracle alone have nearly $600 billion stashed overseas. How could tech companies put repatriated cash to work? Likely with stock buybacks and dividends. Then there is Apple, the world's largest public company. CEO Tim Cook is facing new questions, with reports suggesting that the iPhone X isn't selling as well as expected. Apple is not commenting on these stories, but even if the X isn't living up to expectations, the new and less expensive 8 and 8 Plus could pick up the slack and help Apple deliver strong results on Thursday. For Nightly Business Report, I'm Josh Lipton, San Francisco.
And before we go, here's another look at the market's slide today. The Dow dropped 362 points, and that was off the lows, to 26,076. The Nasdaq was off 64. The S&P 500 down 31. That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
And from me as well, I'm Tyler Mathisen. Have a great evening, everybody. We'll see you tomorrow.